Ladies and gentlemen, I welcome you to the Goela House of Finance. And today we have Gautam Ved. Trust me, this podcast, I was up there taking all the notes as much as I could because whatever he spoke in this podcast was pure gold, and especially for all the investors watching this or listening to this. Now, let me tell you about him. He's a CFA. He has over 15 years of experience in the financial markets. He handles a small case. Adding to this, he is a founder of a research analyst firm registered by SEBI by the name of Stellar Wealth Partners. So, what does a research advisory do? How does he select stocks? How does he choose long term compounders? How does he invest? Has he ever invested? Who is his mentor? All your questions are answered today. So, what are you waiting for? Enjoy the podcast. So, ladies and gentlemen, I welcome you, Gautam Ved. Gautam, thank you so much for coming to the Goela House of Finance. It's a pleasure to have you.
Thank you for having me, Harsh.
So, Gautam, now going through your LinkedIn profile, I have to say that your experience in stock markets is immaculate, right? You are a CFA, you were a senior analyst in Citigroup, then you become a senior analyst in Deutsche Group, then you became a portfolio manager, and then you started your own firm of Stellar Wealth Partners Private Limited. And what I read about it, that it's a SEBI registered research analyst firm. Am I right?
Yes.
Now, Gautam, actually, the thing is that our audience too, they're majorly in 20s, right? From 23 to 30. So sometimes what happens, wealth managers, research analysts, these are such big words that just go above our heads. So explain your firm and what you do in just simple terms without any jargon so that everyone can understand.
So, a research analyst firm which is registered with SEBI is allowed to give a curated basket of stock ideas to our clients, and we provide basic research services to all our small case clients in India. That is what Stellar Wealth Partners Private Limited in India does. You mentioned the term wealth manager. So, a wealth manager is very, very different from an investment professional. A wealth manager actually looks after your entire asset allocation, right from real estate to fixed income to equities and various other asset classes like alternative investments. Research analysts and investment advisors registered with SEBI specifically look at the stock market in particular.
Fair enough. But explain me how the process goes. Suppose let's assume I am 29, right? I come to you, I come to your organization that I want to invest. So how would that journey be for your organization to help me out to plan my investments, assuming I don't know anything about investments in stock markets?
That is the whole idea with which I established Stellar Wealth Partners Private Limited to enable long-term wealth creation for all the busy working professionals in India who do not actually have the time to do the individual research on companies. My basic pitch to all my clients is that you guys focus on your career, your family, your vacation travel. You go on and enjoy life, while I take care of all the research activities and all the research work for you. That is basically our main value proposition for our clients at Stellar Wealth Partners. We do all the research. We provide you with a curated stock ideas list, and then you simply invest in those ideas. And when there is a change to be made, if any company has to be sold, then we issue a sell recommendation and then we replace it with a new stock idea. Because the Indian market is a never-ending stream of opportunities. So at all points of time, we do have a active watch list of stock ideas with us. So if any stock goes, we already have a stock ready to come in. So I think but the key here is to stay the course and just remain invested in the stock market for the long term. Many people confuse long-term investing with being invested in a single stock. That's not what I advocate. What I advocate is remaining invested inside the stock market with a good portfolio for the long term. Because as we are seeing for the last few decades, things change very, very quickly. And just buy and hold or buy and forget will not work in an ever-changing world. You have to constantly keep looking for the antithesis on your portfolio holdings and make the exit when it is prudent to do so. Because the opportunity cost will be very high if you remain stuck in a value trap.
True, very true. I think rebalancing is very important in any portfolio. You can't just simply buy a stock and just forget forever. Gautam, now you mentioned that when a person comes, so you give him a curated list of stocks, right? And you rebalance this portfolio. Basically, that person does not need to worry about anything. You will manage his entire investments and everything for him. But for all the people, because viewers watching this are investors, right? They dream of becoming big. Some maybe in the very initial stages of the investment journey, some in the mid journey. So specifically, how do you, when you pick up stocks, what are the few pointers that you see that, okay, if this points are checked, only then I will look into the stocks? Are there any specific standards you hold for every stock?
So a portfolio well made is composed of two things. Number one, mega trends. These provide you long-term compounding, and you also have shorter-term tactical opportunities like deep value, cyclicals, commodities, demergers. These provide the alpha to your portfolio for outperformance against the benchmark. So a portfolio well made should have ideally long-term compounders as well as short-term tactical bets. And when we are evaluating companies for our curated stocks list in our small case, then we start with a top-down approach. We are looking for industries which are growing. So in India, for example, we have got building materials, affordable housing, digital transformation, cloud computing. These sectors are in a secular growth phase. Once you've selected the industry, then you should come down to the best companies within those industries, the best management teams with proven track records of execution. And if the valuation makes sense to you, then you go ahead and recommend those stocks to your clients. So you want industry growth because that provides you with a tailwind, and you want reasonable valuations because that provides you with a margin of safety, and you want good management quality as well, because just a good business with a bad management can basically not create that much value for you in the long term. You want a combination of all three to come together.
You were right, because there's an African quote. It says that a group of lions led by a sheep will get defeated by a group of sheep led by a lion. So the top level management makes the entire difference. Now, so to summarize it, industry analysis, then you have to look out for the moats, to look at the margin of safety, then you look at the management. Now, you mentioned two things. First, the long-term compounders, then the tactical opportunities that increase your alpha. For people who don't know what alpha is that extraordinary return. Now, for the for the long-term compounders, is it just blue chip stocks that you feel that are the best stocks? So is it that? And for the tactical opportunities, do you follow trends as in technical trends, or is there anything more specific, like a cyclical stock, maybe an agriculture stock is going to do well? Let's take a sugar sector, for example. So
So
is
as
it
far
that?
as compounders in our small case is concerned, we are looking for the future blue chips, because blue chips by definition are the companies which are already large cap
Hmm.
stocks that are already well established. We're looking for emerging blue chips, or the companies which are showing all the initial signs of having the potential to become future blue chips. So that's about the blue chip part. As far as the
Okay.
tactical opportunity goes, we at Stellar Wealth Partners follow a principle called variant perception. Variant perception refers to situations where you get return on capital employed, ROC expansion, coupled with earnings growth, and that leads to valuation re-rating, and then you end up with a multi-bagger. So variant perception can come from various triggers. For example, a
Hmm.
product exchange in a higher margin category, deleveraging of the balance sheet, because lower debt means lower interest cost. That leads to higher profit after tax and higher market cap. It can also come from operating leverage. So once a new capacity has been put in place, and once the pre-production costs have been recovered, then you get disproportionate growth in profits with your revenue growth going forward. So that's another catalyst. Yet another catalyst for variant perception is a promoter or management change. And these are the situations where you get good quality businesses at deep value, because we have seen many cases in India where the underlying quality of the business was good, but because it was mismanaged, the market
Hmm.
does not give it a good valuation. So you end up, when there's a promoter or a management change, when there is a new promoter group with a very established track record of wealth creation or execution, which takes over a mismanaged company, you get a recipe for multi-baggers in the stock market. So this is yet another trigger for variant perception. Then you get variant perception when you can identify a business which is hiving off its non-core operations, because then the market likes focus, stock market likes focused managements, focused businesses. They give it a higher valuation multiple. You also get
True.
variant
True.
perception when there is a divestiture of a loss-making business segment, because once the loss-making entity is spun off or sold off, then the remaining entity enjoys a higher total net profit and thus a higher market cap. And finally, you also get variant perception from changes in the industry cycle as well as of changes in the government regulations. So we have seen, for example, in the last few years, the Indian government has given a heavy emphasis on ethanol blending, and we have had many multi-baggers come from the ethanol space. Similarly, the residential real estate cycle has turned around after almost a decade. That has led to many
Yeah.
multi in the last few years from the building material space. So multiple opportunities for tactical shorter term stock selection and varying perception exist in the Indian stock market.
Very true. I think the viewers who are new to stock markets, they must be like, oh my God, I can't handle this. But the fact is that you're right. And now you mention a lot of ways, right? But Gautam, see, what happens is that when somebody starts to learn investment, so what happens, let's take valuation, for example. There are several methods to do it. Somebody does it with a DCF model, somebody will do it on a government analysis model. And as you mentioned, your entire system, how have you finalized on it? Is it that you have tried everything under the spectrum, then you said this is perfect? Or how have you come to this analysis that this is how you would want to analyze your stocks?
So, one of my biggest eureka moments as an investor came from the 23rd Motilal Oswal Wealth Creation Study, in which they talked about the key principle of value creation. And now I'm about to share that big principle of value creation with you and your audience. And if the viewers can imbibe this particular principle for the remaining part of their investing career, they'll be very successful. In the stock market, Harsh, there are two kinds of companies: one with low returns on capital employed and one with high returns on capital employed. In case of companies with high returns on capital employed, the maximum delta, the maximum rate of change, and the maximum intrinsic value creation happens when they focus on increasing revenue growth. And in case of companies having low returns on capital employed, the maximum delta, the maximum rate of change, and the maximum intrinsic value creation takes place when they focus on improving their returns on capital employed. If you can just understand this one principle of value creation, then you're basically almost there in the stock market. But this takes a long time to imbibe and have the discipline to adhere to this particular principle. I'll tell you why. I mentioned that for companies with high returns on capital employed, they should focus on growing the business for wealth creation and intrinsic value creation. But in case of companies with low returns on capital employed, I mentioned that they should not focus on growing their business. They should focus on first improving
their ROC. Yeah.
This is because if you have a low return on capital employed, which is less than your cost of capital, if you grow your business, you grow your top line, then you end up destroying intrinsic value. This is why you have to understand the distinction between these two categories. And that is what we focus on at Stellar Wealth Partners as well. I mentioned to you, a portfolio well made is a portfolio comprised of long-term compounders. Those are the ones having high returns on capital employed and good revenue growth, as well as tactical opportunities. These tactical opportunities come when the company is transitioning from low returns on capital employed to high returns on capital employed. So this is what is the characteristic of a good portfolio. It's an all-weather portfolio for all seasons, and you can outperform in any kind of market, be it a range bound market or a bear market or a bull market. And that is the key to long-term wealth creation. Because if you just follow one single style of investing, then there'll be a period of time in the middle for 2-3 years when your style will go out of favor. We have seen in 2018-19 bear market in mid cap, small caps, when there was buy at any price or BAP investing taking place in India. But those same stocks have grossly underperformed in the last 2 years because the focus shifted to mid cap and small caps in the last 2 years. So you have to have a good understanding of the underlying market cycle. And from my experience of the last 15 years, I've come to the realization that there is only one single strategy which works across all market cycles, and that is growth at a reasonable price. All the other styles of investing may go out of favor at one point of time or the other, be it a cyclical or commodities or buy at any price. But growth at a reasonable price is the only one strategy which I've noticed works in all market environments. It's like, in my view, the best investing strategy to follow.
That's very interesting. And yes, about the ROCE part, no. If a company has high ROCE, it should focus on revenue generation. If the company has low ROCE, it should focus on improving its return from capital. What's your definition of high ROCE and low ROCE? Is there a specific number to it, or it depends from industry to industry?
Ideally, I would look at a minimum ROCE of 20% or more for the long-term compounders, because the cost of capital for companies in India is generally 10 to 12%. So you want a spread, as big a spread as possible between ROCE and cost of capital, because that gives you the free cash flow yield on a company. So the higher, the better.
So guys, take notes, because I am taking as many notes as possible. So if you can rewind the entire thing and take notes. And Gautam, I really appreciate all of this. And yeah, you're right. ठीक है. Now, Gautam, another thing that you have been in the markets since a very, very long time, right? You never felt like trading, because generally when a person comes into the markets, right? When was the year you entered the markets, the financial market? What was that year?
2007.
2007, right? It's been more than a decade for you. You never felt like trading, because I feel that is a natural instinct that you come to the markets like, hey, I'm here to trade, I'm going to make $1 million. So what was your experience with trading?
I did
if you ever tried it.
For the first 7 years. Till the time I did not develop. So the first 7 years were basically spent in short-term investing, short-term trading, and frankly, I didn't have a proper structured investment philosophy, neither a sound
Hmm.
investing framework in the first 7 years. So those 7 years basically ended up making negligible money. And I only made money in the 2014 bull market, but that was more out of dumb luck, not because of skill. It was only after coming in touch with who is my mentor today, is Utpal Seth of Rare Enterprises. He's the CIO at Rare Enterprises, and he taught me a
Wow.
very important principle of wealth creation, and he helped me develop a very sound investment philosophy. He told me that sticking with good businesses bought at reasonable valuations through the ups and downs of the stock market over the long run, this is the key to wealth creation. And it's so simple that initially I just didn't believe it, but it's actually true, because good businesses and great businesses create wealth across market cycles in spite of all the negative
Hmm.
macro headlines like high interest rates, high inflation, geopolitical tensions, disease outbreaks. But bad businesses or gruesome businesses eventually destroy wealth across the long term, irrespective of whether the headlines are positive or negative. So I highly credit him with helping me develop a very sound investment philosophy, because that is what I lacked for the first 7 years when I used to engage in short-term trading. I even tried my hand in futures and options, lost money. But it is
Hmm.
these mistakes which are your lifelong teachers and as an investor. These are the ones which basically help you remain grounded, remain humble, and just not take excessive risk throughout the remaining part of your investing career. And that is the key to compounding. The key to compounding is long-term survival and endurance. As long as you don't do any stupid things in the stock market is designed in such a way you can't help but become rich over time, because the stock market is basically a symbolism of capitalism, right? It
Yeah.
symbolizes capitalism, and capitalism is designed to generate revenues and profits over the long term, right? So the structure of the stock market is in a favor, but like Benjamin Graham said, the investor's biggest enemy often tends to be himself. It's himself only. So we have to avoid becoming our own worst enemy.
Very true. I feel stock market is a place where you see your true face, right? How greedy you are. And stock market is designed in such a way that it's made out to be so glamorous. Maybe it's because the movies or web series, whatever, that you feel that this is the easiest place and everyone here is in roaming in a Rolls Royce, and that's the picture that I think comes to everyone's mind. Yeah, Gautam, that's completely right. Now, Gautam, when you talk about compounding, right? And you mentioned endurance, and nothing can be more true than that. But it's not easy, right? What happens is that when you look at compounding, generally people will watch a video that you had put this much in Britannia in 2011, it was trading at 211, now you have made this much, this and this much. I feel those kind of contents, they are important, but they create FOMO, oh my God, and you start picturing ki, if I had invested then, today with that money, I would have been doing this, my parents would have been thinking this about me, siblings, spouse, whatever. But when they actually do it, it's a very different story. So if I take the situation right now, right, since I think 2 3 months, markets has not been very favorable, and since the all the majority of the investors are new and majority of the investors are in the midway, they say that now we have experienced the bear market. Just in 2 months, they've understood what the bear market is, and a lot of people are now having doubts and they're asking us everyone questions that should I sell my long-term investments? Should I sell my long-term investments? And the entire fact gets beaten. What would you say to those people?
I would just say, the three golden words: stay the course, because there is no shortcut to becoming rich in the stock market. You have to endure the ups and downs. Periodic downside volatility is the price of admission to higher stock market returns in the long term. That is the basic
Do you
price
think
that
endurance only comes with experience, or you can learn it?
this comes with primarily with experience, I would say. And even in my initial years also, the thing is, till the time you don't achieve financial independence, you'll be in a lot of stress during times of periodic downside volatility. Even I was in the same state of mind for the first 10 years of my investing career. Till the time I
Hmm.
did not achieve financial independence. But once you become financially independent, then you actually are able to evaluate everything with a calm and rational mind that, hey, the stock market is designed to play on the basic human characteristics of greed and fear.
Yeah.
And that is when you get the awakening and the enlightenment. But it's only after you've become rich, when you're in the journey of trying to become rich and achieve financial independence. During that time, obviously, there'll be a lot of stress, and justifiably so. But once you have attained a lot of wealth from the stock market, that is when you actually can relax, sit back, relax, and just take a long term view. You actually become more long term minded after you achieve financial independence, not before you achieve it. That before you achieve financial independence, you're in a constant state of hurry. You're always trying to become rich as fast as possible, but that is the recipe for accidents. When you try to take excessive risks, then you can potentially be thrown out of the game midway. So
Wow.
the entire stock market is structured in your favor. You just have to have the faith in the power of equities as an asset class, and in the power of India and its entrepreneurs and its businessmen and businesswomen, and just have the faith in our country. I mean, in spite of all the ups and downs over the last 30 years, if you look at all the big investors in the Indian stock market, all of them have got one common attribute. They all have a almost religious kind of belief in equities and in India as a country. That is
Yeah.
what allowed them to endure all the ups and downs and just stay put and stay the course for the long term. And they became, among the richest people in the country. That is, but it's simple but not easy, because periodically you'll have bad years in the stock market and you'll keep questioning equities as an asset class itself. But that is a characteristic of equities. It's a feature. It's not a bug.
But Gautam, what you mentioned, no, I think that was so one actually truly gets a long-term view after he's financially independent. Till the point he's trying to cover his basic expenses month to month. And it's very difficult to expect. And I think even we should stop expecting from other people that if he's not financially secure or independent, he will never have that long-term view. So what do you recommend to those people that shouldn't they first of all, two questions. What is financial independence in your terms? I know it's very subjective, but how would you define it? Second thing is that a person who's just entering the markets, or who's in his mid-20s, somewhere around this age, who's not financially independent, he wants to look into the markets. So is investment an option not for him because he would never be able to grasp that long-term view?
No, so basically, it's like unless if you want to reach the eventual destination, ultimately you have to start, right? So if you want to become financially independent, this is one of the best places to do it. If you remain invested in the market, and if you can endure all the ups and downs over a period of 15, 20 years, you would have experienced at least 3 bull markets in between, and that will be more than enough to make you very rich. And financial independence basically means a state of your finances where you don't have to work in a job anymore just for the salary income. You work in a job if you want to, but not because you need to. And last year in July 2021, I quit my job in Summit Global Investments because even though I was earning a good income, I didn't really have to work for a salary income anymore. I wanted control over my time, control over my daily schedule, control over my life. This is the fundamental definition of financial independence, that you can live a life aligned with your interests, hobbies, your value systems, and you can design your day accordingly. And trust me, not having to wake up to an alarm clock anymore is one of the best luxuries. Just priceless. I speak this from experience.
I can imagine, man. I can imagine. 100%, 100%. And you're right. Financial independence basically means there is no benchmark figure because it can be very subjective for a lot of people from different classes. So it's a place wherein all your basic necessities are met. You're not worried about your next paycheck, and you are in control of your time. Basically, you can decide what you want to do with your time. Would I be right in concluding it this way?
Yes. Basically, if you are a frugal person with low needs and low expectations, then for you the bar for reaching a financial independence is lower. But if you're an aspirational person who wants to have a big house, big car, and lots of foreign vacations, then the benchmark for you for reaching financial independence, it will go up. So it depends on individual.
Perfect. Now, Gautam, which is that one industry that you never want to invest in, that you feel that in my experience, this industry it's not my investment style, I don't want to invest in it? Is there any specific industry like this that you just avoid investing that?
There are a few. So there are a few industries which are always characterized by low returns on capital employed. There are industries like aviation, telecom.
I myself was going to say about aviation, that aviation is a very tough business to crack and a very difficult business to invest in. True.
And in aviation, I would like to add one more very important point, Harsh, that you'll see many airlines, for example, Indigo, having high revenue growth, but still shareholder value is destroyed. This comes back to my original point. If you have a company with low returns on capital growing its revenue, then shareholder wealth is destroyed. So it's not about the growth rate of the industry. Many newcomers get attracted by the high growth prospects of an industry, not realizing that it is not high growth which leads to wealth creation. It is sustainable growth with high returns on capital employed. That is the key to wealth creation. So you have to look at both in conjunction. Basically, high returns on capital employed without growth will be a value trap, and high growth with low returns on capital employed is basically value destructive. So these are the two categories of investments you want to avoid. You want ideally both of these together, and you want to look at the sustainability the longevity of these two characteristics remaining in place. That is how you get the long-term compounders, and that is how you get the long-term wealth creation engine in place.
Okay, fair enough, and makes a lot of sense. But would you say, if I talk about the new age tech companies, like for example, Indian markets, FNC, well, Nika, Paytm, do you think these stocks would fit in your category of long-term compounder?
Well, I'm a bit more conservative in my investment approach. So I would invest in those companies once they've achieved attractive unit economics. Unit economics basically simply means high gross profit margins, and good having a positive lifetime value per customer, which most of these new age tech companies in India do not have at the moment. So I think it's much more prudent to have a wait and watch approach. Wait for these companies to achieve profitable and positive unit economics, and then look at them, if at all, for the future. But when there are so many good value opportunities available and having good growth in the market, why will I take risks with these new age tech companies? Basically,
True.
In your individual demat account as an individual investor, you can take these chances from time to time. Even I used to do it earlier, but once you transition to the public side of managing public money, then you by definition you become much more prudent, much more conservative, and much more cautious. And that is actually in a way very good, because then you engage in less stressful investing and much more peaceful investing, and it's just good for your overall lifestyle as well and overall peace of mind as well. So I would rather focus on having growth at reasonable prices or short-term tactical opportunities where the odds are very favorable, and focus on value and not
very true.
Too much far into the future, because that the further into the future that you try to predict to justify an investment, the more riskier an investment is.
Very true, because a lot of times I see people have taken much more risks than they actually needed. They don't need that much of risk, but they've taken a lot of risk on their portfolios. So very true, very true. Gautam, now you are in the States right now when we're recording this, and so a lot of people want to know this actually, right? Because US markets, ideally, you can say it's ahead of Indian markets, right? And specifically in the space of startups and new age tech companies. So Paytm, Nika, all the Policy Bazaar, all these companies have been listed recently on exchange. How do such tech companies do in America? Do they also have the same thing that they have a very high valuation, then they come down, and after that they start doing well, or how does it work out in your experience in American markets?
Good question. And basically, it all again depends on your understanding of the market cycle. These kind of loss money companies or new age companies with unproven record of profitability, they do very, very well, and they find favor among investors during a period of low interest rates and high liquidity. But as soon as liquidity cycle turns and interest rates start going up, these are the very stocks that start deflating the fastest. So if you've seen in America what has happened, the Nasdaq is down almost 30% from its peak.
Yeah.
But individual stocks, especially in this new age tech company category, which did not have any profits to show, they are down anywhere from 70 to 80%. If you lose 80% on an investment, then you risk potentially getting out of the game, right? So if at all you want to participate in such stocks, simply monitor the liquidity cycle and the interest rate cycle. That is the way you can generate alpha. I'm not saying you should avoid these companies altogether, because there is no one route to making money in the stock market. But there is a right time to invest in each different kind of industry or different kind of stocks. These stocks you should invest in when you feel that the liquidity tap is being turned on by the central banks, and you want to get out of them at the very first sign of trouble that the liquidity cycle is turning. At all other points of time, you should ideally stick to a growth at a reasonable price strategy, because that is the only strategy which works across market cycles, be it high liquidity or low liquidity cycle. So having an understanding of the market cycle is very, very important. For this, I would highly recommend all the audience to read Howard Marks' great book called Mastering the Market Cycle. I think it's an essential read for all investors across the world.
Howard Marks, Mastering the Cycle.
Mastering the Market Cycle.
Mastering the Market Cycle. Fair enough. And we'll put the link in the description also, so you can check out the book. Okay. So you were talking about the liquidity cycle. So do you feel the liquidity cycle has turned or has started to turn right now?
It has already turned, and in fact, it's starting from the 1st of June itself, where the Federal Reserve will start engaging in what is known as quantitative tightening. They'll start reducing the size of the balance sheet, and liquidity will start getting sucked out of the system. So it's all going to start anytime now. So investors should now, for the foreseeable future, till the time the Federal Reserve does not begin injecting liquidity again, the focus as an investor should not be on solid sound business models, generating free cash flow, and having good, healthy balance sheets. You should completely avoid highly leveraged companies in a rising interest rate cycle because those are the very companies which are most vulnerable to going bankrupt in a rising interest rate cycle. So again, understanding which kind of companies do better in a rising interest rate cycle or a declining interest rate cycle, this is the key to outperform over the long term as an investor. Just having just the basic macro idea about the liquidity conditions will greatly help you in positioning your portfolio appropriately.
Very true, very true. But Gautam, do you feel that the entire liquidity crunch, because it is essential, inflations have gone to ridiculous levels. Do you feel 2022 is going to be, because a lot of people who've entered the market, a lot of people have entered the Indian markets during the COVID pandemic itself, right? And they are used to seeing figures like markets all-time high, this touches all-time high, market opens gap ups. So people expect a lot of excitement from headlines every day. This is the general sentiment that goes on. So what do you feel, according to you, they should expect in 2022?
I think the next 6 months look challenging. In fact, as long as the high interest rate, inflation cycle remains, I think equities are going to have a tough time, but that's very normal, right? So most retail investors tend to enter around the peak of every market cycle. Many of them entered towards the end of 2017, and then they all saw the bear market, which started from January 2018 to March
Yeah.
2020. If you recall, the small cap index fell more than 60% in those 27 months. The mid cap index fell more than 50%. Individual stocks, thousands of them, fell 70 to 80% over those 27 months. That is called a bear market. It was a 27-month long bear market with brutal wealth destruction. That is what a bear market actually looks like. And that is where actually the biggest learnings for me as an investor took place, because even I had sharp drawdowns in my personal portfolio during 2018 and 19. But those lessons are going to bear me fruits for a lifetime now, because now I've understood that over the long term, it is only about sticking with good businesses. That is the only sound strategy to make money from India, because the Indian markets, as you know, there are more than 7,000 listed companies, but less than 1% of them are actually investable, right? So you have to be very, very sure about the quality of the management and the quality of the business before taking a long-term view on any business. Short-term tactical trades are fine in commodities and cyclicals, but if you want to invest for the long term, you have to be very, very careful in the Indian market, because corporate governance is a very big issue with the majority of the companies listed in India. And this is where having a good, strong network of local contacts, a very good network which can do the local scuttlebutt for you on the management quality, this is where network comes into play. And I tell all my friends and colleagues that in this business, it's just not about your monetary net worth, it's about your network, because your network is what is going to lead to your net worth in the long term. You need to have a very strong network in this business of knowledgeable
Gautam,
people.
you mentioned corporate governance is a challenge in India. Can you explain that more? What is corporate governance and how is it challenge in India compared to, let's say, the States?
So many companies, I'll give you a lot of examples here. So many companies in India follow a very aggressive revenue recognition policy. We follow what is known as an accrual accounting concept, accrual basis of accounting. But many companies take advantage of this principle. They follow it by word, but not in spirit. And that is where they engage in aggressive revenue recognition policy. They also engage in manipulation of the numbers which they publish through various accounting shenanigans. For example, they can modify the depreciation rate to manage the volatility of the earnings. They can charge off a lot of expenses directly from the reserves and surpluses on the balance sheet instead of taking those expenses through the profit and loss statement, thus inflating profit. They can capitalize the operating expenses if they want to, because they have that discretion. A good example here is the pharmaceutical industry, in which research and development R&D is a normal operating cost, but some companies may want to capitalize that operating R&D cost to smoothen out earnings. So these are some of the red flags that you have to be very careful. There are multiple other red flags as regards corporate governance which you need to be on the lookout for.
So this doesn't happen in the States?
Very less, because here the regulations are very strict and very, very tight, and here the corporate governance standards are much, much more sound and solid.
Fair enough, fair enough. And right, there's one thing that every Indian investor has to understand, and this is something you have to experience. And I feel what you mentioned about the bear markets, the bear markets are the markets which build endurance, which we were talking about earlier. That you need endurance in the markets.
In those bear markets, all these bad corporate governance companies, the stocks of these companies will be the first to deflate and get washed away. And it happens during every market cycle, and during every bear market, all the new investors learn the same old lessons which we that all us experienced investors have experienced in the past, and
Yeah.
all these points I'm talking from experience because I've actually lost money engaging in these bad corporate governance talks in the past, and now that I've actually borne the brunt of the losses, I don't want others to bear the same losses, just like I did by making the same mistake. So it's
So
very
Gautam,
important.
it's very important for someone. It's for even someone to realize a mistake. I've seen people who are doing the same thing again, expecting different results, and they're unable to see this is not working for them. That this is not the right thing. So yeah, for you to realize it, it's how long did it take in your journey in financial markets to realize this? How many years did it take?
Almost a decade, almost 10 years. First 7 years,
So,
I was engaging in a lot of short-term trading, and I didn't have an idea what was happening. I was just there for the excitement. So only when I started developing my investment philosophy, started reading up on value investing, reading good books, learning from my seniors, juniors, and colleagues, everyone. And
hmm,
it is a time-taking process. There's no shortcut to this. You have to actually go through the grind and eventually improve every day. It's all about the mindset. So a very important question to address for many people is the what is the mindset that people should have in the stock market. The mindset should be that of a constant learning machine and that of humility, because humility is the
yeah.
gate to attaining wisdom. If you're humble in this business, then you'll have an open mind to learning constantly from others, be it your colleagues or juniors. You'll want to learn from everything around you and everyone around you. That is the right mindset to inculcate for long-term success in the stock market. And I would issue a cautionary word here for everyone that be humble, or the market will eventually make you humble. So be humble. There's no
Yeah.
the biggest losses for investors take place when their short-term success goes to their head and they make a lot of money in the bull
Yeah.
market. Eventually, when the bear market arrives, those are the very people who get wiped out the fastest.
I think I'm forgetting who quoted this, but you are the most vulnerable after you've made your biggest profit. And you're right, market. This happened with me also. When I entered the markets, my ego was here that technical is so easy. It's so easy. Why can't people make money? And after 6 months, I came back to the level. So markets definitely has that nature. And there's another point that I think everyone should note that it took Gautam 10 years to realize this. And so for people who are expecting that and they get irritated, why am I not learning the markets in 1 or 2 months? It is not possible. You need to take time. It's a process. You need to build endurance. Now, Gautam, there's another very massive trend that's going on that a lot of people they say, I don't Indian investors I'm talking about. I don't want to invest in India. I directly want to trade in the US. I only want to invest in the US stocks and maybe because of the corporate governance issue that you mentioned, people think that's definitely a better option. What would your advice be to them? Do you think it's good or it's okay or what's your advice?
I would just say this in the US market. See, I've worked as a portfolio manager in the American stock market for almost 5 years when I was working with Summit Global Investments. So, from my experience, what I've noticed in this country is here the high growth, high revenue growth is only primarily limited to the technology
Hmm.
companies. But at the same time, 99% of the technology companies listed here basically show very high top line growth, but negligible
Hmm.
profitability or no profitability. So they were very much in fancy for the last 10 years when you had a declining interest rate environment. And
Can you name such tech companies that you were mentioning about that they have high valuation but less revenue growth?
there were so many of them. There were companies like Zoom, Peloton, Affirm. There were many technology stocks which are still showing very high revenue growth, but they are in the very initial stages of building their business and building their unit economics. So
Hmm.
they were in favor among investors while the interest rate cycle was favorable. But now most of them have deflated by more than 70-80%. So you'll
Hmm.
see this again that when the valuations compress, when entire industry goes out of favor,
Hmm.
investors' interest in those businesses are the lowest. But this is the
Hmm.
time after these companies have fallen 70-80%. Now is the time to engage in bottom-up analysis and start. If at all you want to invest in the US market, this is a very good time because many stocks are now trading at very attractive valuations. I mean, look at companies like Google, Microsoft, Facebook. Facebook is a free cash flow machine trading at 15 times price to earnings now. Google is at 20 times earnings. Microsoft is at 25, 26 times earnings. For these kind of growth rates in India, we end up paying 70, 80 P multiples. But in US, these high growth free cash flow generative companies are available between 15 and 25 P. So it's fine to
Oh.
invest in the US market if you want to, but be very careful with the valuations, which the valuations which you want to pay up for these kind of companies. And there are some very good opportunities available after the big market crash in tech stocks over the last 6, 7 months.
You're right, because I think the main attraction for all the people who want to invest in US markets is the tech stocks like Zoom, Amazon, Berkshire Hathaway. and because of fractional shares also. But you're right. One should not only be just blinded by the valuation, the attractiveness, or the cool factor they have with it, but also for the fact that even if they're worth it or not. So Gautam, today was a legit. It was a masterclass. I had a lot of fun. Now I want to ask one last question. Right? I ask this to everyone. Is that what is that one thing that you believe in stock markets, but others disagree with you?
Okay, this is a good question. So I personally believe that there is, many of us in the stock market tend to get deeply rooted in one particular single style of investing, be it a value investing or a growth investing. Many people tend to just disaggregate both these concepts and talk about dividing all the investors into two different camps, deep value or growth. But for me, growth is an essential component of value, and all intelligent investing is value investing. So this is one area in which I believe is very true, that you should focus on intrinsic value and not just look at P multiples or price to book multiples, because they are a second order derivative. They are not the drivers of value, they are the output. So you have to just focus on the intrinsic value as an investor, not just get rooted to one single style, high growth or deep value, because styles of investing keep going in and out of favor all the time. But if you simply have a razor sharp focus on intrinsic value all the time, you shall do very well over the long term as an investor.
I think yes. Sometimes people get emotionally attached to one method, and one is blindsided that he does not even want to consider other possibilities. But you're right. One should definitely have. Well, I think the main point you mentioned, that as an investor, you should always be humble and hungry to learn. I think this would again come to that point. Okay, Gautam, thank you so much for giving me your time. And guys, I highly recommend The Joy of Compounding, Gautam Vaid's book. I will drop the link in the description, and he has a YouTube channel, but he's not making any YouTube content on it. So go to his channel, subscribe, and tell him in the comment box to make more videos, because we are hungry to learn from him. Gautam, thank you so much for joining us. It was a pleasure.
Thank you, Harsh. It was a pleasure. Thank you.